So I think overall we're seeing a little bit more signs of recession pressure. It's been much delayed, and we're still not seeing really acute signs of recession, but the labor market is getting softer. But I think, the actual result is a little bit less narrative driven than that. I think a lot of it is just rebalancing. But one thing is, I think that what matters for people is how many times they've seen it come and go.
Yeah.
So if you were not aware of like the first 3 cycles, for example, and you knew about it in the 4th cycle, or at least you paid attention to the price, you remember seeing it in a bull market, you remember seeing it in a bear market, you've seen a bull market again. That for them, that's only the 2nd cycle, even if it might be the 5th cycle of Bitcoin. And when you look, of course, if you look at a price chart in linear form, you don't even see those earlier price bumps. So you only ever really have your memory, or in visual form, you see the past couple cycles. So I think people have to go through a handful of cycles, not just that Bitcoin's gone through those cycles, but that they've seen it gone through those cycles. I think that's important. And 2, the volatility is still an issue until it's not. Basically, until it's widely adopted and liquid enough. And I think there's a couple ways to think about this. So, I mean, if you're in Argentina or Nigeria or Lebanon or Turkey or wherever, a general trend in developed markets is that people want dollars. Like, I know, like physicians in Egypt that stack physical dollars in their apartment for lack of knowing what else they're going to do with their savings. They might hold some gold, they might hold some physical cash dollars, and then they'll buy a second apartment, which might or might not be empty, just to have something more tangible, right? So, and one of the challenges in these markets is that banks and airports, you can only bring so much cash through an airport. Banks are only willing. Usually, it's hard to get dollars from the banks in these countries. Usually, you have to get out on like the street market, like the gray market or the black market. And stable coins are a way that kind of pierces in there. It gives people another avenue to get dollars. That's why they're somewhat popular now. But of course, the problem is they're still centralized, right? So all that someone is doing with a stable coin is, instead of trusting their local banks to hold their dollars, or not even being allowed to, it's basically just an offshore bank account for the middle class. That's what a stable coin is, and it's centralized, and it's just that the central hub is not in their country. Now, so basically, dollars are essentially predators for any weaker currency, like all these developing market currencies. And where Bitcoin comes in is a couple different ways. One is if it starts to get more widely adopted and liquid enough that it has less volatility, and the volatility it does have is still in an upward trend in price, and people have seen enough cycles, that's hard to ignore. So that's number one. And another thing to think about, that Bitcoin has to reach certain levels of market size and liquidity before it even interests certain bigger players to get in. So when Bitcoin had $1,000 in daily trading volume, a person couldn't put in $1 million. When Bitcoin had $1 million in daily trading volume, a billionaire couldn't, you couldn't come in with $1 billion. It wasn't ready for sale yet, for example.
Yeah.
When it trades $1 billion a day, these large pools of capital, like a $1 trillion insurance fund, it's just, they look at that and it's like a small pond for them. It's like they would sneeze at it and it would move the price. When it does tens or hundreds of trillions of dollars in volume, then these bigger players can start looking at it. So it's almost like you have to kind of saturate, or at least you have to hit a certain level before you even get interest from the next level. So now we're at the phase where the BlackRocks of the world are kind of paying attention to it. So one is just, you can keep going up in that one psychological cycle. So people, once a person has directly seen 3 cycles, for example, that's hard to forget. And then 2, that liquidity. And then the other angle, like that's kind of Bitcoin winning. The other way is the dollar losing. Like the dollar's tripping over itself. So a lot of people here, maybe not everyone, is seeing what happened in the recent bond market move, right? So long end bonds have sold off dramatically in recent weeks and months. The yields are spiking. And, whether or not what happens in the next few months or whatever, I think that's not the big story. The big story is that historically, when you get larger and larger debt in an economy, eventually you run into a big bubble. And then what happens is the public sector absorbs that debt onto the public sector. Right? So that's what we saw in Japan over the past 30 years. We saw a gigantic private debt bubble, and then kind of a deleveraging, printing money, And then a lot of that debt is now on the public sector, and the private sector in Japan has less debt relative to other metrics than it used to, less net debt, because a lot of that's now on the public sector. And in the United States, we saw pre-global financial crisis, we saw more and more private debt growth. Then we saw the whole collapse and the money printing. And now we see some degree of household deleveraging and things like that. But all that debt's now on the public level. And then what happens is when you run into the next cycle or the one after that, and all that debt's already on the public level, you're getting higher and higher interest expense. You're not offsetting it with lower and lower interest rates, right? So, for example, during the past 40 years in the United States, we had higher and higher public debt to GDP, and we had lower and lower interest rates. So the interest expense on the public debt was never really a problem. But once we hit the point where you hit zero and you bounce off zero, and now you're just kind of either going sideways or you're going up in interest rates while you're still going up in debt to GDP ratios, that's when you start to get into an outright fiscal spiral. And if the Fed finds itself having to do QE, even when they have above target inflation, because they just have to monetize the deficits, that's kind of a checkmate scenario. We already see Japan in that scenario. So,
do you think we've crossed that event horizon now?
I think we're flirting with the event horizon. Yeah, I mean, basically, once you get over, say, 100% debt to GDP, and it's usually a couple mix. It's usually like you get above a certain amount, you bounce off zero interest rates, now you're just either flat to up, and then you run into some degree of commodity shortage, energy shortage, a pandemic, whatever you run into some sort of like supply side thing, and that combination is like fireworks.
Yeah.
And so Japan today, they have a 2% inflation target. They've been above their target, and they're still doing QE because they're in that weird position. So money creation happens in one of two ways. Either banks lend it into existence with fractional reserve banking, or you monetize very large government deficits. And when public debt is small, like say back in the United States in the 70s, most money creation comes from bank lending. And if you raise interest rates, you kind of slow down the bank lending. And although you do increase the government deficit because of your interest expense, that's a smaller portion. So higher interest rates are suppressive for money creation. Whereas if you are all the way in Japan's case, where you have like 250% debt to GDP and very little bank lending, it's a very sluggish economy. If you raise rates, you're actually potentially accelerating money supply growth because now the government is pouring more money into the economy due to payments on its own debt levels.
Which is very counterintuitive.
Yes.
Yeah.
And so that's kind of either the end stage of the currency or at least kind of the end stage of what, say, Ray Dalio would call a long-term debt cycle. So some sort of major devaluation, recapitalization of the market. So if the dollar trips over itself, and the Fed finds itself in kind of what Japan's doing, but Japan has a trade surplus, current account surplus. They've built up a positive net international investment position. The United States is running a structural trade deficit. And if they also find themselves forced to constantly do QE just to maintain the bond market, and Bitcoin's still here, and people have seen 3 cycles of Bitcoin, I wouldn't want to be short Bitcoin.
Yeah. One other question on the audit of the payments technology side of the house. You hear a lot of people say that on layer 2, we're really kind of struggling to make it technically feasible or turnkey for people to self-custody on the payment side. That they're relying on outside or third parties to basically manage the keys on their behalf so that they can do that. Is this a problem? And then I'd say the better question is technologically, how do you think that something like that can be solved so that it is more user-friendly for people to self-custody and still be only using Bitcoin primarily as a payments technology?
I mean, that's been one of the age-old debates in Bitcoin is like, what trade-offs can you make? Basically, it's hard to scale a blockchain. And so if you make more throughput and make transactions cheaper, you risk having a threat to the decentralization of the network, harder to run a node. And so that's the challenge there. So far, the second layer solutions, I think, compared to 5 years ago, some of these second layer solutions either didn't exist or had non-existent liquidity. So I think the fact that we've already come this far in, say, 5 years is incredible. I think it'll look way better in 5 years from now. So I wouldn't judge the current UX in a similar way that I wouldn't judge the internet pre-browser or even just post the browser, right? I mean, basically, over time, the internet got easier to use, or even operating systems, like before you had Windows, when you had DOS, for example. We're in like the DOS era, or like we're in like the first Windows era. We're not in the super easy to use era. But even then, there still are like hurdles on the horizon. Generally, for example, non-custodial Lightning is a little bit more UX issues than, say, just fully custodial Lightning, for example. And people, I think, somewhat rightly criticize that. But I think it's important to remember what we're trying to optimize for. Like, is everyone going to use non-custodial all the time? And if so, why? So I think like when we put an order of importance on what would you want to be non-custodial, say your savings or your payments, most people pick their savings, right? You want your savings to be non-custodial because if something happens to your savings, that's worse than like if you were using a custodial payment service and then they block you, then you say, well, okay, I'm gonna use non-custodial payments, right? So maybe not everyone in the world needs non-custodial payments at the same time. It's just that they all need the option to divert there should they need to, and it's an easier to switch between, say, payment providers or to go non-custodial with your payments, like with your checking account, than your savings, because getting your savings rug pulled by a custodian, you can't just be like, well, I'll pick another custodian now because your coins are gone. So, say, like, the non-custodial savings aspect, in my opinion, is the more important thing to focus on. Non-custodial payments, I think of it in terms of ensuring that the optionality is always there, and not fretting too much that most people don't use it all the time because if their payments are not getting blocked, they have less incentive to go to the higher friction use case of like this fully self-sovereign payment thing, and it's a low risk to them if they do get blocked because there's not a lot of money at risk, and they can just then start using the higher friction optionality kind of fully cypherpunk payment methods. So I think that's kind of the order of importance that I place on those.
Is there any technology in particular that you're excited about that would potentially enable people to self-custody on the payments side, like FEDI or anything like that?
Well, so FEDI is interesting because it at least decentralizes custody more than it is now and makes it more private. And so I actually think that the Chalming mints in general, so there's FEDI mint and then there's Cashew. For people that aren't familiar, 40 years ago now, actually just over, well, 40 years ago, he wrote the paper on running David Chalm wrote running a basically how to have mutual parties run like a shared database or a ledger. It's kind of like proto Bitcoin back in like 1982. He's kind of the grandfather of some of the technologies we have today. But he also did eCash, and basically it's like a private way to custody money. You can like put money into this like custodial vault, and the custodian can sign it and validate and give you a token, but they don't even know who you were, and they can't really keep track of which token is which. And it never really took off because the base layer was the dollar, and it's shitty. So, and if the base layer itself is not private and it's censorable and it's inflationary, it just didn't really take off. They just got beat by MasterCard and Visa back in the 80s and 90s, and it didn't really go anywhere. And with the recent like Chalming Mint kind of focus, it's basically saying, wait, we can take this 30 or 40-year-old technology, and actually it's way better on Bitcoin.
Yeah.
We're using types of encryption on a money that's now more suitable to it. So I'm actually really excited that it's only been maybe a couple of years of development, more years of theory, a couple of years of development, and some of these products are starting to hit the market. They've got like test apps out there and things like that, and I'm actually pretty excited that can be both a privacy improvement and a UX improvement over the medium exchange elements. And then, of course, if you're using those types of systems and you grow a big balance, then you pull into cold storage savings, because that's where the more money you have with a custodian, the more risk you take.
If you found value in the content, hit the like button, as that helps us reach more viewers like you. If you're not subscribed, hit the subscribe button, as we put out daily content to keep you updated. Thanks for watching, and we'll see you in the next one.